All right, everybody, ladies and gentlemen, good evening and welcome to us here at ATFX. My name is Philipp and I have the pleasure and honor of being your presenter for tonight's webinar. Yeah, risk comes from not knowing what you're doing. Of course, that's a quote by Warren Buffett. And yeah, we want to have a deeper look and understanding about what it is about that quote, what is it about risk, and how can we tackle risk, and why do we have to tackle risk as traders in order to become successful traders in the market. If you have a look at your webinar interface, you can see that small questions box. Right now, I'd appreciate a very short yes or why in that box to just let me know that you guys can hear me well, that you actually saw the first slides changing, and so that we have the technical sorted out. Perfect. Thank you much, everybody. Really appreciate the feedback. Guys, obviously, I know everything that I'm telling you tonight, but we want to learn something together, which means please follow this webinar. Think about what I'm telling you. And if something is not clear, which is perfectly fine, this is just shows that I didn't manage to explain things properly. Please, if something is not clear, please do ask questions. I'm really looking forward to having that interaction with you guys. And there are no stupid questions, and I do my very best to answer your questions as we move through the webinar tonight. Tonight's webinar is scheduled to run for around about 1 hour. And of course, before we get started, you already do see those first risk disclaimers here already on the screen. Please take a moment of your time to read through them carefully and make sure that you're comfortable with them before continuing with the session. Essentially, this says that trading, of course, involves risk. Yes, this is what we want to talk about tonight. And you should understand those risks and the instruments you're using before you're getting started in the markets. Neither ATFX nor Trade with Position nor myself are registered investment advisors, and therefore nothing that we say should be considered to be actual investment advice. All examples are shown for educational purpose only. We're doing the whole webinar on the live platform, on the MetaTrader 4 platform here at ATFX. Please, just because I tell you something about those charts, it's never ever a trade recommendation. You must have a strategy, you must have a plan, and what I'm telling you is what I'm seeing on those charts. However, I don't have a crystal ball. Nobody has a crystal ball. And I have my fair share of losing trades. And we will talk about that in a moment, why this is perfectly fine. Why having only winning trades is definitely not what trading is and should be all about. And it can't happen. Nobody ever has that perfect track record. There is no holy grail out there. There's always risk when we place our trades, and we must address and manage and mitigate that risk. And so I'm telling you what I'm seeing on those screens. I explain how I read price action and what I assume could be happening next, which might be a little bit more likely than not, but that's just my opinion, my approach to trading. In the end, when you're putting your hard-earned money on the line, you must own that trade, which means you are perfectly confident and you perfectly understand why you put that position on. And just a random guy on the internet telling you what he sees in a chart should never, ever be good enough for you to place a trade in the markets. Please don't go hunting for any tips or chat rooms or forums or anything like that where people give you and try to hand you fish. No, please, by all means, learn how to fish yourself. It's not that difficult. It's not that, you have to have the proper mindset and you have to have the proper approach. This is what tonight is all about. So just looking at a chart, never ever, me explaining what I see there, that's never a trade recommendation. You must own that trade for yourself. So please make sure you're okay with that. And that being said, let's just get started with tonight's agenda. Warren Buffett's quote, risk comes from not knowing what you're doing. We want to explain that a little bit further. The importance of having proper risk management in trading and why having proper risk management is actually our job number one as traders. Know your risks. What are sources of risk and how can we prevent and mitigate those risks? And of course, everything, as I said, already here coming directly on the live platform. So without much further ado, let's just directly jump into the platform itself. And yeah, right now we're looking here at a chart at British pound against the US dollar, but that's not important tonight. It's not, I really use those charts and screens just for explaining the ideas. It's not about the market. Forget about the market. Could be any market, could be any time frame here. So Risk comes from not knowing what you're doing. So let's just turn this around and arrive. All right, we should be knowing what we're doing. All right, so obviously it sounds like we should have a plan. And this plan is pretty much what trading should be all about. You need to have a plan. Just coming home from your normal 9 to 5 job or any other way and just sitting down in front of the screen and say, all right, now I want to be trading. It doesn't work like that. You must know what you're looking for. What is your approach to trading? What time frames do you intend to trade? Which markets do you intend to trade? What kind of strategies do you want to trade? And only when you find those setups which are in line with what you're seeing there, then it makes sense to actually place those trades. So trading is always something that should be coming from the market. The market should show itself, price action should prove itself and give you an idea about whether the setup that you're looking for is actually there or not. And if it isn't there, then it's perfectly fine, and not only perfectly fine, but rather you must sit on your hands and do nothing and wait for those opportunities to show up. One of the great books of trading, Reminiscence of a Stock Operator, Edwin Lefebvre is the author. One of the famous quotes from that book is, "It was never my acting, my trading that made me all the money, it was my sitting." Being able to just sit and patiently wait for things to happen, for things to set up, or once that trade is on, just waiting for the trade to unfold and develop itself and give you the kinds of profits and price action that you came there for in the first place. This is what is crucial. So you want to have a plan. And we here at Trade with Position like to call our plan obviously our trading strategy. You want to have a precise idea what it is that you're looking for. And this is not something that you should develop live in the market. Yes, you can do that, but while you are developing or learning another one's strategy, which is perfectly fine, at least to get started with, you should focus on understanding and learning and mastering that strategy. You shouldn't be trading at that moment. At least that's my opinion. Learning is so much more important than actually being trading there in the first place. And once you've learned that strategy, then you know precisely upfront what you're looking for and how you want to implement that trade. And therefore, we like to tell everybody you want to plan your trade, but then you just want to trade your plan. Set up everything, decide everything up front. Where you want to enter, where you want to exit, how many contracts, how many lots you want to have in your position. All this must be done up front. And once you know all that, you can just enter that order, submit the order, and essentially your trading then is over. You're done. You've taken care of everything. With MetaTrader 4, you can submit both take profit targets. You can submit also stop loss orders, and the stop loss and the take profit are combined into a so-called OCO order. One cancels other, which means you don't have to manage those two orders separately. Once that trade is on, either the stop is hit, all right, then automatically the take profit part is canceled, or the other way around, your profit target is hit and then the stop loss order is canceled as well. So plan your trade and then just trade your plan. All right, but how do we plan our trade? What's the big idea here? What is our strategy? And I can just explain you guys a little bit what is our bread and butter strategy here at Trade with Position. And our strategies are trend following strategies. And once again, guys, just because I explained you that strategy right now, I do not suggest that this is the best strategy out there. I do not suggest that it's the best strategy for you guys. It's a nice strategy. It works very well for us and it fits our style of trading. Your style might be completely different. With trading, there is no one size fits all. It's all about you have to find something that you own and that you can work with and live with and that makes sense to you, where you feel right at home and understand everything, and it just clicks and it feels like a natural move. And for us, it's a trend following strategy here at Trade with Position, which means we are looking here at a moving market. We're looking here at a daily chart currently of British pound against the US dollar. And what I see here on that chart is a moving, a trending market. That's the first thing that I'm looking for in our setups. I want to see a trend because I feel, and it makes sense to me, if that's absolutely the case or not, I don't know, I don't care, I know that it works for me. I'm looking for a trending environment. Why do I want to have a trend? Because I think Newton's physics, if something is in motion, it stays in motion unless an opposing force is applied. And therefore, if a market is moving in one direction, it's maybe a little bit easier for that market to continue to move in that direction than to bring it to a full stop, reverse action, and move in the other direction. I feel that this takes more effort involved by the market participants. And therefore, I feel if something is in motion, it stays in motion, and I want to go in that direction. You can think of that also as a big river with a big, mighty current, strong current, pulling you towards the sea. You can jump into that river and you can try to swim upstream, but this will take some effort. You can manage to do so, of course, but overall, if you just want to move away from where you are, I feel that just playing that man, floating in the water and let the current and the water carry you with it downstreams, I feel that this is much easier and you're probably getting farther than trying to go against the momentum, against the stream. And therefore, our approach to trading is trend following. We're looking for a trending market. We're looking for price to make lower lows and lower highs in a downstream, in a downtrend, or higher highs and higher lows in an uptrend. And this is what we're seeing here right now. British pound moved lower, lower lows and lower highs. Then big pullback, slightly higher, higher high here, but again another lower low, another same high, higher high slightly, but now again pushing lower, lower lows, lower highs, and the market is making new lows here. Next thing that I like to see in my trending environment is I like to look at my moving averages. I'm looking here at a 10, 20, 50, and 200 period moving average. Doesn't matter if you pick the exponential moving average or the simple moving average. I'm not interested in those crossovers. I'm not interested if price breaches this level, this moving average or not. You can trade those signals. Those are the traditional signals, those that you can find on every website, in every book, in every YouTube video. Yeah, when the moving averages cross each other, that's your signal. I don't think, yes, this can be a signal, but I don't think that those are very good signals. Why? Because you're usually late to the party. This means you get that signal when, yeah, the high or the low was in maybe 10, 20 bars in the past. Back then, it would have been nice to get this information. All right, we're making a high, we're making a low. Price is about to turn around. That would be a leading indicator, giving you an idea about what might be happening next. However, moving averages crossing each other, that's a lagging indicator. Let's just pick the red one and the green one here. Red crossing below green, 50 to 100, that's the so-called infamous dead cross, bearish sign. All right, it's nice that this is bearish, but guess what? The highs were in back here in the day. This was when it would have been nice to sell this market, not here. On the other hand, 50 crossing above the 200, the infamous golden cross, doesn't get more bullish than that. If you just trade that signal, you're supposed to make a killing in the market. But let's just see what happened here. Actually, from then on, it's just downwards. Lagging information. You are late to the party. I don't like to be late to the party. I would like to get that inside tip. By the way, the next great party is tonight and it's going to be there and then. This is what I would like to know. Not tomorrow's newspaper and then reading, oh, this is where I should have been. lagging indicators versus leading indicators. And so why are those moving averages then on my charts? First, I like to see what we are calling here our fanning pattern, which means I'm just looking at the structure of those moving averages. I just see that the 200 is above the 50, above the 20, above the 10. I only get this structure when the market is moving, when the market is trending. You see that fanning structure is setting up here and then pushing onwards. And this fanning pattern extends. So I don't have to look at the highs and lows to try to specifically and precisely say whether that was an uptrend or a downtrend. I can take a shortcut. I can just eyeball the structure of my moving averages here, and it tells me, yeah, this should be a downtrending market overall. And you see, when those pullbacks are deep, the fanning structure pretty much disappears. But when it starts to expand and to move again, the fanning structure comes back into place. So this is a shortcut. This is a shortcut to help me to speed up my scanning process, to just see really those markets which are trending in the first place. All right, that's the first thing. I want to see a trend, and I can use my moving averages to quickly help me to identify whether that market really is in a strong trend or not. Usually we get the question at that point, wait a minute, you told us about the trend and you told us about the fanning pattern, fanning structure, but this is just the daily chart here. What is the trend of the market? There is no trend of this market. There's only a trend of this market in that specific time frame, which means the daily chart here is in a downtrend. The weekly chart here pretty much is giving me that same structure. The weekly chart also is in this downtrend, lower highs and lower lows. The monthly chart is also in a downtrend, lower lows and lower highs and lower lows. I talked about stacking the odds in my favor when it comes to putting trades on. Now I just know, and I've just seen with very simple technical analysis, I've just seen that three major time frames give me that same picture. They tell me the same story. This market is in a downtrend. So what do you think is more likely to happen in the bigger picture? That market is continuing to go down, or that market out of nowhere just says, well, I've gone down long enough and now I'm just off to a new bull run. I feel it's more likely that the market will continue lower. But please note, I think it's more likely. I don't know, nobody knows. I've just analyzed, and I think what I've seen, it's a little bit more likely to go in one direction than in the other. And with this a little bit more likely, this is how we can make money in the markets. I had one a little bit more likely on the daily chart. Guys, just a quick second. Sorry guys, had a nasty cough sneaking up on me, and I wanted to spare you guys the pain of hearing me coughing. The daily chart is going down. First indication. Maybe this information that the daily is in a downtrend has switched the odds of having a successful short trade from just 50-50 to maybe 51-49. Maybe it's more, maybe it's a little bit less, but it has tweaked the odds a wee bit in my favor. Now I can add the information that yes, the weekly chart also supports that story. All right, maybe we are now already at 52-48 or 53-47. I hope you can see where this is going. With every type of analysis that I can perform, I want to tell a story. And every analysis technique that I can use helps me to put more flavor, more meat to that story, to make it more rich, to make it more sound. And this is how I arrive at the end of the year with hopefully more winning trades, than losing trades. When people are getting started with trading, they think if they perform their analysis perfectly, then obviously they will only be winning trades. And that's just not the case. That's a fairy tale. Won't happen. There will be losing trades. And if I perform everything perfectly with my analysis, I will still have 40 losing trades out of 100, maybe only 30, but there will be 30 losing trades. And this doesn't tell you anything about when those 30 trades will happen. It's not that you will say, all right, they always take turns and just a few more winning trades in between. No. That's a completely statistical random process here. I just know roundabout the odds for each. Let's think about this as a coin toss. But with my technical analysis, I've been able to tweak that coin to move from a 50-50 coin now to a 60-40 coin. But every single trade is independent. The outcome of that trade is independent from the outcome of the previous trade and from the previous trades or the next trades. It's just like the spinning of the roulette wheel in the casino. All those spins are not connected in any way. But of course you want to think, and the human mind is wired in that way to think, all right, I had now 3 losing trades in a row. Now we must have a winning trade coming up. It's just so much more likely now for this winning trade to come up. Same thing happens in Las Vegas in the casinos. They have big screens there telling people how many times there has been red or black in a row. And when those numbers go up, 20 times red in a row, the usual side is that people will rush to that roulette table and just bet on the other color. Obviously, it has to be that now this other color has to come up next. Can't be that red is coming up so often in a row. But once again, this is just a trick that your mind is playing on you. The spins of the roulette wheel are completely independent. They are not connected to each other, just like our trades. Since this means the probability that after 20 times red coming up, another red will come up is pretty much half, 50%. Let's forget about those green zeros and double zeros and that stuff, the edge of the house for a moment. Let's just say it's 50-50. Guys, even if there have been 20 times red in a row, for the next spin, the probabilities are 50-50 again. And this is also true for our next trade. If I have had 10 winning trades in a row, the probability of my next trade being a winning trade is 60%, roundabout. If I've had 10 losing trades in a row, it's not the next one has to be a winner or it doesn't work at all, I just quit my trading now. No. The next trade, the probability is again 60%. Those events, statistically speaking, are completely independent. They are not connected to each other. This is absolutely crucial. And while you will tell me now, all right, this makes sense that they are not connected, and all right, your mindset will go crazy on you when you have those 10 losing trades in a row. It won't be fun, it won't be nice. You will find lots of reasons why that strategy is just not working. Anything. Your broker is out there to get you. The markets are completely against you. It's Mr. Powell, it's Mr. Trump, it's Mr. Johnson, it's the Queen herself. No. All those things don't matter. It's your strategy. You've backtested your strategy. You know the win rate of your strategy. Let's just say 60-40. And that's it. And now you have to accept for yourself that the next trade being placed has 60-40. And just because you had 10 losing trades in a row does not mean your strategy is no longer working or anything. You want to plan your trade and then trade your plan. And of course, you must do a proper review and understand and analyze if you really executed your strategy flawlessly in the market, if you really didn't screw up your trade implementation. And that's perfectly fine. Happens to all of us, happens to me. Time to step back, time to think about what you've just done. Is there a lesson to be learned? All right, let's learn that lesson and let's continue. But apart from that, just a certain winning streak or losing streak means nothing. How do we make money in the market? We want to have an edge. This is why we use our technical analysis here. We use that technical analysis to arrive at a higher win rate. A win rate hopefully in our favor. Winning 60 trades, losing 40 trades. Very crucial component of our strategy. But the second component is that we want to win bigger. We want to have a consistent risk exposure on our trades, which means that if I lose 4 trades out of 10, I must make sure that the losses that I will have to pay for on those 4 trades never ever can or should be larger than the gains that I take out of those 6 winning trades. Callum is asking, and thank you very much, Callum, for that question. What are the lines on your screen? The green, red, blue. Those are my moving averages, and this is a 200 period moving average, a 50 period moving average, 20 and 10. And I don't care if it's a simple or an exponential moving average. I use them to understand what the trend is doing, and I'm also using them to spot good deal areas, I like to call them. Price is never ever moving in one direction forever. You see, price dropped all this way. Does it continue now? No, it doesn't. From time to time, price has to pull back to catch its breath. And I want to have an idea where price might be pulling back to. I don't know if it's going to happen precisely all the time, but I want to have at least an idea. I want to tell a story. And I use the 10 and 20 period moving average to help me to identify that potential good deal area where price is no longer overextended. Price pushed all this way here to the downside. Now we've pulled back. We're now sitting very close to those price equilibrium levels here. And then price is continuing down towards the next leg, towards the next lower low. That's the second use of my moving averages. I want to see that price is not overextended when I initiate the position. Same story here. I can see the price pushed lower. The moving averages have started to fan again. Do I want to short this market right now? No, because we are sitting a bit of the distance between where price is trading right now and to where a good deal might be had is just too large for my taste. And right now we can see a bullish candle setting up, which just means, yes, price is currently pulling back towards those price equilibrium levels. It's fixing that slight overextension that we had here. And while this is a downtrend here on the monthly, on the weekly, on the daily, guess how would the 5-minute or 15-minute chart probably look like when we just see this bullish candle here? I would assume that those shorter time frames are now in an uptrend. Let's have a look at the 5-minute chart. Sure enough, big push here to the upside. Then lots of sideways action, slightly crawling higher. Is it really a good strong uptrend here? No, absolutely not. It isn't. And we can use divergence as another leading indicator here to help us to think that price might be about to turn down soon, but get a feeling for how those different time frames are connected to each other. Just the daily chart is pulling back in a downtrend, but this pullback has to present itself as some kind of uptrend here on the lower time frames. Get a feeling for those different time frames and how they connect with each other. And if I want to trade the daily chart, I would wait at least for a little bit of pullback more to occur and to take me here into that moving average sell zone or very close to it, and then I would be looking for potential trading opportunity. having an idea about where that market might be taking you. Let's have a look at a different market here. And here we're looking at gold. Gold on a daily chart. And let's have a look at the weekly chart. Another technical analysis technique that I like to use are just simple, boring horizontal lines of support and resistance. And people always think you have to have sloping trend lines. I like to use horizontal lines because they are way more precise and way more actionable. Again, ultimately, it comes down to what you like best and what works best for you. I can just give you ideas. I can just tell you what works for me and my colleagues here at Trade with Precision. But ultimately, it's your trading strategy. It's your setup. We like to use those lines. One touch, second touch, close encounters here. So obviously something around this 1360, 63 level in gold seems to be interesting right now. Next thing that I like to use is, for example, Fib retracements. I'm going from the most recent swing point low to the current swing point high. And I can see, all right, this horizontal line here is sitting right between the 38.2 and the 50% retracement. All right, let's drop down to the daily time frame. And yes, it was from this move, but let's draw in the next Fib retracement from, again, the most recent swing point low, which would have been this one here, and draw it to the same swing point high. And now you can see that the 61.8% retracement of that move is pretty much sitting right on top of my horizontal level of support and resistance. I think I've identified a potential pullback target. If price is pulling back, where do I think that price might be pulling back to? I think price might be pulling back towards this level here of something between 1360 and 1370. Now, how would this be actionable? How could all right. First, I've performed my analysis and I've started to note things. I've started to note certain occurrences, things coming together on that chart. Now the question is, all right, how could this be tradable? My strategies are trend following strategies, which means I'm a wee bit reluctant to trade that pullback here because this would be a counter trend move. The weekly chart is an uptrend. The daily chart is an uptrend here. And therefore, going for this counter trend move, remember, I want to swim with the current. I don't want to put in a lot of effort and try to go against the stream. No, I want an easy trade. I want to have a boring trade. And going against the trend is, at least for me in my perception, way more risky, and I want to be with the trend. So how can this be traded? A potential trade could be to say, all right, I think I've identified a potential pullback target. I think I've identified that price might be pulling back towards this 1370 price level. And then and there, I could be waiting with a buy limit order. If price is pulling back, it will trigger me into that trade. If price is not pulling back and just continues higher, so be it. I missed on that opportunity. That trade just didn't manifest itself. And that's perfectly fine. I've had those types of setups where I waited for the pullback and the pullback was just a few pips, a few ticks too shallow. Not deep enough, didn't get triggered in. Everything else was perfectly fine. So be it. Don't get emotional, don't get caught up with those things. It just happens. Here I would be waiting with a potential entry at, let's say, something around this price level here. So the upper line here would be my potential entry. Now, I have an idea. I think price might be pulling back. I think price will then, after this pullback is over, after this current overextension is fixed, price might be resuming in the original direction of the trend. That's my idea, that's my trade. But what if things don't work out? What if price just keeps on dropping and the trade just doesn't work? I must have a plan for that. Remember, you want to have a complete trading plan. to address your risk. You want to manage your risk. But in order to manage your risk, you must first know your risk. And a crucial part of that is I know where I want to get out if this trade doesn't work out. When do I know that this trade doesn't work out? If price drops below the 100% retracement. Why? Why here? Well, the idea is that price is giving me here an uptrend, higher highs and higher lows. And therefore, I'm waiting. My most basic assumption is that this is an uptrend. However, if price now drops all the way and takes out this previous swing point low, then I no longer have an uptrend because I no longer have that series of higher highs and higher lows. I have a higher high being followed by a lower low. And this means that at that point in time, that trend is gone for good and I want to be out. So the most logical place for me is to have my stop loss here behind this 100% retracement. With FIB retracements, another good place that many traders like to use is the 78, 72% retracement. I don't know the number by heart, which comes from me just not using it. I feel that this 70-something% retracement really isn't that strong of a, it's just not that actionable for me. I just don't see and understand why price should be reacting to this level. It's a rather weak retracement, and this whole logic of if we drop below the 100% retracement, I have no longer an uptrend, but I wanted to trade an uptrend. So this means my uptrend is gone, my trade should be gone as well, which is why I personally like to put my stop losses always behind this 100% retracement level right here and there. So that's the big idea. I know where I want to get in. I know that I've analyzed this market and I've come to the conclusion that this market is an uptrend and we now might be pulling back. I've performed my technical analysis and think I've identified a potential pullback target where I want to enter that trade. And I know where I want to get out if things don't work my way. I enter that trade up here at this price level, and I exit my trade if things don't work out down here at this price level. Simple as that. So I have a stop loss and I need to have a stop loss in order to have a well-defined risk position. Now, I personally like to submit my stop loss. I like to submit my whole order, entry, stop loss part, take profit part, all at the same time. Some of you will tell me, no. The very moment I submit my stop loss order, everybody knows my order and everybody's out there to start hunting my stops. Personally, I have only had that experience once. And this was a broker and there it happened regularly. No, it definitely was not ATFX. I can guarantee you that, fingers crossed, pinky swear. There it was obvious I did get fills on those trades where those prices didn't even show up on their charts afterwards. So yes, I've had it happen to me, but only once, and I didn't stay with that broker for long. You can believe me there. Now, I like to have that comfort of that order just being there. The very moment I have submitted my order with attached exit brackets, I can walk away from my desk. I no longer have to pay attention to the market because I know my orders are there. Yes, if the markets are moving fast, I will have slippage, but I will have a pretty well-defined risk position on. So personally, I always submit my stop loss order. If you say, no, I don't take that risk, I want to watch the market and I can and I will submit my exit order the very moment price hits that level, that's fine, under the condition that you really can do it. Personally, my mental game just isn't strong enough. That's not something nice to tell about yourself, but that's just the way it is. I've tried it often, and every time I was just sitting there like that small rabbit in front of the snake and just, oh, please come back, one point, just a wee bit more. It never ever worked out for me. It's just weakness of my character, or I don't know, and I don't care because I don't have to care because I can submit my stop loss orders. I know other traders who are perfectly fine with, yes, that's my mental stop loss, and yes, price is here, cluck, the position is gone. It works for them, it doesn't work for me. Your mileage may completely vary, you pick what works for you. But please, by all means, always have a stop loss, because only then can your position have well-defined risk exposure. What is risk? Risk is the distance between the entry and the stop loss. And now obviously the question comes also into place, how many contracts, how many lots, how many shares do you want to trade? Those are the three components, but please always have a stop loss. And I personally also feel that this stop loss should be in a logical place. And I'm having a lot of discussions with a good buddy of mine. And he is telling me, Philip, the great strategies that are out there, they all tell you you should have a stop loss about 7% from where you entered. Now, obviously that's just 7% in price. I don't see it. I don't understand why that 7% should be so great, because what's completely missing in this one is volatility. If you told me you want to have a stop loss at 2 times the ATR or 2 times the standard deviation away from your entry point, at least you've taken care of volatility, of the speed and how fast the market is moving. However, I still feel that this idea, that's my swing point low, we are in the context of an uptrend, and if price drops below this level, then the trend is gone, and then I want to be out. That this is a good logical stop loss location. It makes just sense to me. Again, test what works for you, with which approach you can live best. I want to have a logical explanation about why this is a good stop loss location. Why does technical analysis work after all? People are looking at those charts, and this is not just a random number generator. Putting out those numbers of price action, this is, by the way, everything the same story, or that's the story that my professors back at university told me all the time. Yes, price log yields are perfectly normal distributed, and it's just a random process, and that's it. No, it isn't. Why? Because people have been trading, people have been acting in those markets. And what we see here on those charts are just the footprints that those people left when they were trading. We can see here the observable results of their actions. But price is not random. Price was the result of those people trading and acting in the markets. Attila is asking, and thanks again for that question, could you please elaborate more on that stop loss at 2 times ATR? Sure, no problem. How fast does the market move? What is the speed of the market? That's the so-called volatility of the market. And now you do have different ways of measuring that volatility. I think probably most of you have already heard about those infamous Bollinger Bands. And those Bollinger Bands are just a technical indicators. Let me just try and see if I can find those Bollinger Bands here. Let's have a look at trend and Bollinger Bands. Here we are. And the usual setting is, I think, 20 periods and 2 times the standard deviation. How are those Bollinger Bands plotted? Well, they just take a moving average, a 20-period moving average, and now you calculate the so-called standard deviation, which is just a fancy way of saying, all right, how far is price moving away from those, from this average on average? So you just see how far is price away, and you try to average that out, and that's the so-called standard deviation. Now what you can do is you plot that standard deviation with a given factor. Usually it's 2 times plus 2 times the standard deviation plus that moving average, or 2 times the standard deviation being subtracted from that average, and those are the Bollinger Bands. What can you see with those Bollinger Bands? You can see that there are periods of low volatility and that there are periods of high volatility. And this is pretty much what we're seeing here. Price is moving sideways, and those Bollinger Bands are just very, they're going flat, just as price is flat, and they're very close. The distance is minimal here between the moving average and the Bollinger Bands. But now as price is picking up and we are starting to trend again, guess what? Those Bollinger Bands are expanding. So Bollinger Bands are being plotted using the standard deviation. Now, another way to calculate volatility or to measure volatility is the so-called average true range, ATR. And the ATR, let's just get rid of those Bollinger Bands here right now. And the so-called ATR is an average of the true range. And the true range just not only compares how large is today's candle, but also how large is today's candle with regard to yesterday's close. It analyzes three different distances involving yesterday's close, today's high or low, or today's high and low. And that's pretty much the largest of those three is the so-called true range. And you can now average that true range over, let's say, 14 bars. This is just another way to measure volatility. And so why are some people using that idea of I put my stop loss at 2 times the ATR? When I say 2 times the ATR, it could be something like, all right, I want to enter at this price level here. Now I want to plot the ATR, and I want to subtract 2 times the ATR from my entry price. The idea here is, what is the ATR telling you? The ATR is telling you, well, over the last 14 days, price on average moved for, let's say, 5 points. And what I'm doing here by giving it 2 times the ATR, that I can say, all right, I want to give my trade at least so much wiggle room that 2 times the average movement for each day. So if just random noise happens, random noise going against me for 2 days, I'm not being stopped out. I'm only stopped out if price moves against me further than that. That's a volatility-based stop loss location. However, I feel that this volatility-based stop loss location just is sitting there pretty much in the middle of nowhere, and it's not that meaningful. Again, if you make that narrative and tell me, I think I've anticipated the turning point, and therefore after that 2 times the average move going against me, then it's not the turning point I want to be out. Perfectly fine. It's not the story that I like to hear and I like to tell, but I can understand the story and it's perfectly fine. This comes now down to what is it that you like best, and yeah, what's your strategy? Same thing about stop management. I like to keep my stop loss in that logical place. I only would start to move up my stop loss if I can find another good logical place, like another new higher low where I can put my stop loss next. This is why I personally wouldn't use a trailing stop or use parabolic SAR or indicators like that for this, because I prefer to be my stop losses in a logical place. If you like to move your stop losses around, your stop loss locations around, and it works for you, by all means, keep on doing what works for you. That's the beautiful thing about trading. Trading can be pretty much everything that you want it to be, as long as it works for you. Attila, did that explanation about the average true range, did that make sense? All right, perfect. All right, perfect. Thank you much for the feedback, guys. Really appreciate it. All right, so I want to have a stop loss. I want to have that stop loss in a logical place. The next question is, how many shares, how many lots, how many contracts should I be trading? And we have to answer this coming from two different perspectives, 2 different steps. The first step is I want to think in money terms. Let's just assume that I have an account of 10,000 pounds, 10,000 euros, 10,000 whatever. And now I have to decide, all right, how much money am I willing to risk if this trade doesn't work out? And what many or most of the best traders and most successful traders out there are agreeing upon is that risking 1% of your account on that trade is usually a fairly smart decision. What does that mean? Doesn't that mean that the resulting position will be so small? No, I'm not talking about the position size. I'm talking about how much money am I willing to risk. And I have my 10,000 pound account. I'm willing to risk 1%. So this means if I'm triggered into my trade and if I'm being stopped out, let's just, for the sake of demonstration purposes, let's just assume I want to trade. And this is not, let's drop down, see if we find something better here. Let's stay with the daily. I want to trade this. I think that I've identified the pullback. Again, it's not a good trade setup, but by no means. It's just for the sake of explaining things here. I want to trade the breakout of this candle here to the downside. I've identified this level before. I see and think that price might be about to break down here to the downside. I want to enter on the break of the low of that candle. Next thing is, when do I want to be out? I want to be out when I think that this is no longer my, let's just assume it was a lower high. As soon as the high of that candle is invalidated, I want to be out. Why? Because I no longer think that I've identified my new lower high in that downtrend, and for that reason, I want to be out. So I want to be out at that price level. So my price level for entry and my price level for stop loss are coming from the chart. That information, however, how much money am I willing to risk on that trade if it doesn't work out? This is coming not from the chart. This is coming just from my account. And I'm just saying, all right, I'm willing to risk 100 pounds, 1% of my 10,000 pound account, 100 pounds. If that trade doesn't work out, 100 pounds are gone, and that's okay, because guess what? I'm down to 9,900 pounds. Does this feel great and awesome and thrilling? Absolutely not. Losing never is fun. But on the bigger picture, it doesn't matter. I can trade the same markets with pretty much the same exposure, same contract sizes, and so on with 9,900 pounds than if I had traded with 10,000 pounds. So staying small is crucial. I've talked before about having many losing trades in a row, which is not likely, but which is absolutely possible. Risking 10% on one trade, 5 losing trades, and your account is now down to 50%, which means you would now have to double your account just to break even. Shooting for 100% is pretty daring. And you take all that pain away and you give it lots more room and time to work out in your favor if you stay small and risking 1%. So I know my entry, I know my exit, and I know that I want to risk 100 pounds. So how many contracts can I trade? Well, I need to know now the distance between my entry and my stop loss. And this is then that I take to a so-called position size calculator. And the good news is the internet is pretty much full of those. And I've just here randomly picked one. The website is called babypips.com. Just look around there for the position size calculator. I'm not sponsored by those guys. There is no affiliation or link or whatever between Baby Pips and ATFX, nor Trade with Position, nor with myself. It's just one of those calculators that work just like a charm and are really nice to use. So I'm pretty sure I know that there are also decent add-ons out there for MetaTrader 4. Pick what you like best. This is just to illustrate the idea about what's going on here. We're looking here at a 10,000 pounds account, or it's US dollar, I don't care. All right, pounds. How many percent risk do I want to take on that trade? Well, we just said 1% is just fine. And now let's just assume that I'm risking that trade that I'm about to take. The distance between entry and stop loss is, let's say, 50 pips. And the currency pair that I intend to trade is the euro against the US dollar. And right now, we must know what the exchange rate between British pound and US dollar is. Why do I have to enter that? Because obviously, I'm trading something where my account currency is not involved. And the tool must know, all right, how does this base pair, the base currency, the US dollar, relate to my account currency? 125.037, 125.037. Now just hit calculate. And I'm seeing here, I'm risking 100 pounds, which is perfectly fine, which is exactly what I wanted to do. 10,000 pounds, 1%. And this means that I could be trading 25,007.4 US dollars. So standard lots would mean that my position size on that trade would be 0.25 or 2.5 mini lots or 25 micro lots. Guys, this step here is crucial because right now we just know where we want to enter and where we want to exit, but we must connect this to this 1% risk. And this is how we calculate the position size. Play around with that stuff. And usually I'm not a big supporter of paper trading, but for this makes perfect sense. Just paper trade, just have a look around, try to find some setups. They don't have to be decent setups, but practice this step with calculating the proper position size. This is absolutely crucial. If you screw up that step and now don't trade 0.25 lots, but just say gut feeling, let's go for one whole lot on that trade. Guess what? You're risking then 4% of your account, which is way too large. This is really a crucial concept here, guys. Absolutely crucial. Get your position sizing right. If you screw up your strategy, if you screw up your entries, if you screw up pretty much anything, but you master that step here, that risk management technique of doing proper position sizing, you will most likely be around long enough to learn enough and to master those other aspects of trading. This whole step here is completely there for survival. It's absolutely critical and crucial that you master that step. And finally, while we are moving over here to the final slides here of that presentation, I mentioned having the proper mindset a few times tonight. And the only thing that I can really suggest to you guys is have a look at the ancient Romans, at Mark Aurelius, and the Stoics. And one of the core principles of the Stoics is there are things we can change and there are things we can't change. And understanding this and accepting it for yourself is so crucial and critical when it comes to trading. I can control many things. I can control if I want to place that trade. I can control my position sizing. I can control where I put my entry. I can control where I put my exit. I can control all those things. I can't control what the market will be doing once I'm in. I have my strategy, which should take care of the odds, but the outcome of any one single trade is random. Understanding which things you can change with trading and which things you can't change with trading is critical, at least for your peace of mind. And you want to have that peace of mind because remember, this is not about the next trade. This is not about having only winning trades. This is about the next 100 trades, or rather, this is all about the next 1,000 trades. And you have to have that stoic mindset. This is not laissez-faire. This is not I'm just at the mercy and peril of the markets. No, there are many things that we can control. We can't control everything. Trading is a lot like sailing. You cannot force the wind to blow from one direction or into one direction. You can't control the weather, but you can control which way you want to steer. You can control which way you want to set sail. And ultimately, it doesn't matter which way the wind is blowing. If you know how to sail, you will get to your destination. It's the same thing with trading. You can't force the market to do anything. But if you know how to trade, if you know how to manage your risk, you will get to your destination. Not within one trade, you won't be a millionaire overnight, but let's think about the next 1,000 trades. Let's think about the next 10 years. Things that we can control and things that we can't control. Adila is asking, what platform do you suggest for paper trading for Forex and stocks? MetaTrader 4 really is a nice platform. You can easily sign up here for that demo account just to get started and get a feeling for the platform. You want to practice using the platform. You want all the mistakes that you will make using a new platform always on the corresponding paper trading account demo platform. It won't prepare you for the psychological stress of trading as soon as your money is on the line, but getting the platform down, understanding how everything works, which type of orders to use, where to click and what those clicks might do to your positions. All this can be easily learned and trained on the platform. And MetaTrader 4 surely is a nice platform for that. Thomas is asking, and thanks for that question, is the same risk management on short sales and long sales? I'm a beginner, thanks. Absolutely no distinction there whatsoever. You use that same logic applies there. Let's just quickly jump back to the slides here. Sorry guys if we're running a little bit over time here, but this was a short example here. So that would be my entry and that would be my exit. I just take the distance between this and that. It doesn't matter if that's a short trade or if I'm looking here for potential long trading opportunity. There is my, come on, here we are. Let's just assume that this was a buyable opportunity, which it wasn't. My entry would be just here. My stop loss would be just below the swing point low, somewhere around here. And it's the same story that applies here. What is my entry price? What's my stop loss? What is the distance? And now I have to, I do just the same calculation, British pound, US dollar, and the distance, this one minus that one, so many pips. How many of those lots may I now trade that those many pips are equal to a money risk of 100 pounds? Simple as that. So yes, absolutely same story applies there. Long, short, doesn't really matter. And also my whole analysis techniques stay absolutely the same. And I don't care if I'm trading the market to the long side or to the short side. Callum is bringing up the point that it makes sense to stay also in line and up to date with what the markets are doing. Absolutely. And guys, have a look at the ATFX website. There's a so-called market calendar there. And this market calendar can easily help you to get a feeling for which news events, scheduled news events, obviously are about to happen. For example, tonight there was the Fed chair, Mr. Powell, speaking to Congress, giving ideas whether they want to hike the rates or whether they want to lower the rates. And this news event was out there. Obviously, they didn't know the info before, but they knew that he was speaking, and this is always a huge potential to move the markets. And sure enough, the very moment that whole session started there, the S&P 500 really jumped at least, I think it was at least 10, 15 points. Which is pretty huge for that market to move in that short period of time. Staying in sync with the markets, being aware of those news events, absolutely crucial. You can easily do that on the ATFX website. Why should you guys consider ATFX? You have seen the platform here today in action. It's a pretty powerful platform. It's not one of the most easy to use platforms, but you can do a ton of customization. And once you get a feeling for MetaTrader 4, there's hardly anything that you can't do with that platform. Learning curve might be a little bit steep, but it's definitely worth the effort there. Platform, great access to markets, great spreads on those markets. Trading is a business. We want to keep costs low. Tight spreads are the way to do so. And also you want to have a good and solid business partner. And with ATFX, that's definitely given, regulated by the FCA in the UK, license number you can see here. Easy ways to fund your account, to withdraw money from your account. The platform, we talked about that. And in case there are any questions, they have a very well staffed and well guys, come on. I wanted to say well-mannered, but obviously they're well-mannered, but knowledgeable. That was the word. A very knowledgeable trade support and support hotline. So please, by all means, if there are any questions, give those good guys a call. Speaking about giving them a call and where they're situated, not somewhere in Malta or somewhere else, but here, United Kingdom, directly in London. You see the numbers to call, email addresses to contact in case of any further questions. Please, by all means, reach out to them in case of any further questions. Now, just reading whether and seeing if we have any further questions, but I don't see any. So guys, then for me, this would be a wrap. Thank you very much for tuning in. I hope you learned something new, you found something useful. Please guys, by all means, focus on risk management. It's absolutely there for survival. And once you survive that learning curve, trading is just awesome, believe me. All right, so a very nice evening to all of you. Thanks once again for tuning in, and happy trading over those next few days, and looking forward to catch you guys again soon. Thanks again, take care, and bye-bye.